Welcome to the Pension Insurance Corporation Infrastructure Debt Investing Roundtable. My name's Jonathan Stapleton, Editor of Professional Pensions. This debate will look at the sorts of asset that make up infrastructure debt, why schemes are interested in the asset class, and how to invest. Joining me to discuss these issues are Mark Gull, Co-Head of Asset and Liability Management at Pension Insurance Corporation, Wrenn, Managing Director of Infrastructure Debt at Blackrock, and Mike Weston, Chief Investment Officer at DMGT. Welcome. Mark, if I can start by asking you, what sort of investments make up infrastructure debt?
Well, I think there are quite a lot of definitions, but on the broadest definition, people would look at issuers involved in infrastructure, and that can be utility companies, transport, social infrastructure, so things like houses and schools, energy, and as well as that, there's also project finance debt as well. So there's quite a range. And I think what's important for investors is a lot of the big issuers from things like utility companies, they will already be involved in because they sit in listed corporate bond markets where there are lots of mandates. For some of the smaller issuers, project finance, that's a bit more difficult to access in terms of debt, and that's something I'm sure we'll touch on later in this discussion.
Thank you very much. Chris, what's sort of the general characteristics of these sort of investments, and what sort of makes them particularly suitable for scheme investment?
So, as Mark said, there's quite a wide variety of businesses there, but they do all share the same characteristics, which are that they tend to be capital intensive businesses with a long-term horizon, and generally speaking they are less exposed to commercial demand risk, so they have a more stable revenue base than one would find in the normal corporate world. And so this is really one of the key features that makes them attractive from a long-term buy and hold perspective to institutional investors like pension funds and insurance companies.
Is this a sort of investment that schemes are looking for, Mike?
Oh, absolutely, Jonathan. It's perfect. We have a long tail of liabilities that we have to fund to pay the pensions of the schemes. So if we can find assets that generate long-term cash flows that we can match off against the liabilities, it's absolutely perfect.
And Mark, how can schemes access infrastructure debt, and sort of especially for sort of project finance deals? I mean, should they be looking at direct investment or outsourcing? You know, what resources does a scheme need if it's going to insource this sort of process?
Well, I mean, I think that's a very good question, because if you look at the listed corporate bond market, there are managers out there looking at those things the whole time. But for the smaller stuff, if a piece of debt is being issued that is too small to join a corporate bond index, let's say it's less than £100 million, there won't be very many people looking at that debt. It might be an individual project, and the investors in that might only be one or sometimes two potential investors. They really need to understand that debt. They need to be involved in the structuring of it. It may have, it may have some quite technical things in it, depending on which sector it's in it. So it is a resource-intensive area to get involved in, and also it requires a certain scale, because there's a question about if you're doing all that work to understand a credit, there is a de minimis size in which, beneath which it is not worth investing in, because you spent so much time, and the cost of doing that is too little. So you definitely need a certain scale to do it, and you need to build up resources that understand the issues around the sector, can do the credit analysis, the ongoing monitoring, and indeed all the governance issues that go around it.
Yeah, I'd certainly endorse that. I mean, it's probably the biggest challenge in a way that our clients face, that many people can see the merits of infrastructure debt, and in particular the private debt, where there is this sort of illiquidity premium to be captured, but the question is, how do I get access to that pipeline? It requires quite a proactive origination approach. You know, it's a market that's been controlled by the banking sector. We've had this shift now where the banks are pulling back from their ability to hold long-term debt. They're looking to bring institutions alongside them, but that's just at the beginning. And so any investor really that's looking to come into that market has to have a strategy for getting involved in that pipeline. And obviously that's where using a fiduciary independent manager can help, because they're in the market and can bring that access.
Mike, do you think there's a case from a sort of pension scheme, institutional investor point of view to actually look at these from a in-house basis, or do you if the deal of certain sizes, or do you think the sort of outsourcing is the only way to go with things like infrastructure debt?
Well, there are a number of things that you'd have to bear in mind to make that kind of decision. I mean, one is simply the regulatory perspective. Are we allowed as a pension scheme, do we have the right regulatory approvals to directly invest in things like this? Second is the whole sourcing issue that's been mentioned. If we wanted to do this in-house, how would we actually get access to the deals? I think once the deals are in place, and again we'll probably talk about this later, it's just a question of keeping the interest payments coming and recording the fact that they've come in and checking the covenants aren't being breached. So the ongoing maintenance isn't a particularly difficult task, but I think there's the sourcing issue up front and all the upfront due diligence before one makes an investment, even assuming that one's allowed to make an investment. So it's for most pension schemes, it's going to be very difficult to do this in-house. So you'd be looking for somebody like Chris as a manager or a fiduciary, somebody who's got all that expertise, and you can just say, we like the strategy, the asset class matches the demands that we have, it would fit in the portfolio. What's the most appropriate implementation strategy? And there will be a few schemes that are big enough to do it in-house, a few people like Mark who can do it in-house. Certainly at the smaller end of the pension fund world, you wouldn't even contemplate doing it in-house. And then there's the middle ground, which is probably where DMGT sit, where it'd be a nice thing to do if we could find something that was sort of super attractive, but it's certainly not easy by any circumstance.
And Mark, you really need sort of resource to do this. I mean,
completely. I think that's a very important thing, and you have to understand that these are deals that people are effectively competing for. It's not like you're buying something that's already out there in the market. If you're, particularly if you're getting involved in the project finance side of things and the deals that are being originated, there might be 5, there might be 10 people also trying to get involved in that same deal. And there are deals that potentially you get shown that you don't think are good enough credit quality. You have to have the ability to screen those, and you have to understand that you're only going to invest, or probably going to invest in a small number of what you see. So that there is the resource commitment, the time commitment, and there is a degree of uncertainty about what you can actually invest in. As well, some of the returns might be competed away. So I think you have to consider all those factors, and as part of a strategy as a place to invest, we think it works very well for us matching long-term pension liabilities, but we're conscious of the fact that we have to show a certain amount of flexibility around sourcing these deals, and we understand that sometimes we will do a lot of work and nothing will happen, and that we have to factor that into our cost base.
And I don't think we're at the stage that the documentation is standardised yet, is it? So they're all a bit different.
I mean, project finance almost, not quite, but almost by definition they are a bit different. But you can get deals in the same sector that come out quite similarly. I mean, we've been lucky enough to do 3 solar deals, and the second 2 were an awful lot easier than the first 2 in terms of the effort that we had to put in, because we were understanding the issues and the documentation and exactly what you needed to make the credit the right sort of quality. We had a much better handle on having worked through it earlier.
And I think investors need also to be able to feel that they can say no if they actually don't like the terms that are being proposed. So it might be a nice underlying transaction, but the structure or the covenant package or the terms are just not what a particular investor is looking for. And you need to be able to say no, that doesn't work, without fearing that you're never going to see another transaction because the market will avoid you. And this is another dilemma, I think, in terms of direct investing. And
I think that's a really crucial point you make, because a lot of these, particularly where you are the sole investor or one of a couple of investors, the assumption we make is there is unlikely to be liquidity in that credit. So if something does go wrong and you're thinking you wanted to sell it, you could do that with a normal listed bond. But for these debt issuance, that may be very difficult. So you've got to be very confident that you're getting the right sort of credit quality at the outset. And part of that is saying no, or saying for us to invest, we need these certain terms and we can't compromise on those.
Sort of taking that forward, Mark, and looking at the governance challenges posed by infrastructure debt. How can investors, certainly if they go down the sort of in-house route, sort of monitor these investments on an ongoing basis? I mean, that surely is a huge amount of work in that.
Yes, there is a large amount of work. I think and we are conscious of the fact that that there is an amount of work. They, again, come back to one of the issues around resources. You need to have the right resources to do that. You can also, when you're structuring a deal, put in information covenants, meaning that the structure that you're investing in, the piece of debt, they are obliged to give you certain bits of information at certain times. So that can help you very much with your monitoring. And if things were to go wrong, you have to recognise that potentially to work these things out and get the best solution could take a lot of extra work too.
But I think from a pension scheme perspective, looking at the various different asset classes we invest in, I wouldn't say it has a considerably greater governance burden, because essentially if you've got everything defined up front in the documentation, if all goes well, you are just checking that the interest's been paid when it's due and the covenants aren't being breached. And if it all goes well, that's the battle we've got to do. Clearly, if something goes wrong, that's when it starts becoming a bit more time-consuming and resource-consuming. But in terms of, let's say, the governance effort in looking at global equity portfolios or other kind of fixed income portfolios or hedge fund portfolio, I don't think it's hugely different. I think the difference is the effort that needs to go in up front to the due diligence to get it set up, and then after that it should be relatively more stable.
Chris, would you agree?
Yeah, I think the only observation I'd make is that these are living and breathing businesses, so issues come up over the long term. We bought a loan, in fact, a couple of weeks ago, and within 24 hours of us settling it, we had a waiver request in from the borrower on a particular issue. And so, that required immediate attention from a member of my team to be able to deal with that issue. So, although they're very similar to other businesses, I think any investor needs to expect that there will be requests from the borrower and comments and developments will occur. And the borrowers are very keen, as we move from this sort of banking model to an institutionalized model, the borrowers are nervous and in a way need convincing that the new lenders will be able to respond to the issues that come up. And so that's an issue in its early days, but that's something that has to be developed.
I think there's one more issue I'd just like to touch on is that of ratings, because a lot of how we invest, particularly as an insurance company, a lot of your capital rules are set by ratings. Now, for some smaller type deals, the cost of having external ratings can affect the economics of the deal. If you go down that route and you decide you want to assess things yourself, you have to have a process around internally rating some of these things, and the governance around that is something that you have to set up and monitor and look at quite closely, because you have the individuals bringing the deals in. Clearly, they're keen, and once you get on a deal, human nature is such they're very keen to get the deal done. You have to have an independent challenge to that to make sure you're getting a very cold-headed assessment of really what the ratings is, and you have to have the ability to understand and implement ratings as well. So that again can add to the governance if you go down that route of deciding that you need equivalent ratings and you're going to do that yourself.
Yeah.
Looking at, you mentioned earlier, Mark, the flexibilities that the sort of increased flexibility an investor needs to have when looking at this type of asset. Is there a little bit of a risk that investors can get a little bit too focused on one particular area, so perhaps sort of give you sort of capacity issues, or perhaps by the time you understand one particular opportunity it's passed away and another one's popped up? Do you need to be flexible with these deals and quite open-minded as to whether you sort of invest in one type of infrastructure debt or another?
Well, I think if you give yourself a broader range to invest in, it always gives you more opportunities. The danger, as you say, absolutely, is this infrastructure debt has been talked about a lot, and there's certain sectors where people have said, yes, that makes an awful lot of sense. They tend to be the sectors that are well known to institutional investors, and those are ones typically where there has been a certain amount of issuance from the bigger companies in the listed corporate bond market. And I think the classic example is something like the social housing sector. And very strong credit metrics. We believe the deals work very well, and you've seen big deals, over 150 million go in the listed market. However, there are quite a lot of small social housing associations that are no longer being financed by banks for the reasons that Chris has given, that want to issue as well. If you have a dedicated fund or a pot of money set up for that sector, the danger is, because there's small deals there, those deals are getting squeezed, and you're not getting the necessary illiquidity premium that you should get for those deals. So I absolutely agree with your point that the ability to be able to say, no, I'll go off to another area, and that discipline about what is good relative value, I think is hugely important for investors.
Do the outsourced providers, Chris, do they sort of almost is there a risk you get pigeonholed into some of these areas and almost specialise in certain areas of the market, perhaps where you've got strengths in sourcing these deals, or do you sort of try and keep as open a mind as possible?
We work pretty hard to be able to meet all of our clients' needs, of course. So and this is a characteristic of the market is that different investors are looking for different things out of infrastructure debt in terms of maturity, interest rate profile, credit risk, return profile. These are all variables within the same sector. So what we think is there is a certain amount of flexibility required in the way we think about it, but clients need to know what they're looking for in terms of the income profile, and then be fairly open-minded about where they find that, having defined their sort of risk appetite. And so the model that we are adopting is a sort of managed account model where a client would essentially have their own portfolio of investments, and that gives flexibility to define the investment criteria, have as much involvement in the decision investment process as they want, receive information or not as they choose, and that's quite a flexible model. The market will move, I'm sure, towards a sort of commingled fund structure in due course, but that does require putting people into the same structure, which is more challenging.
I think basically if a pension scheme or chooses to invest in this as an asset class, we're highly unlikely to go to Chris and say we just want social housing, or we just want this, or we just want that. We want a steady return out of infrastructure debt as a whole. Yeah. And just like any other asset class, if you can build a diversified portfolio, it's going to be more robust. So diverse by issuer, by credit, by geography, by function, by sector. A diversified portfolio that's going to hit our targets, and then just leave it up to you guys to source the stuff to match that.
No, it's about striking the right balance in terms of sort of diversification versus actually being able to assemble a portfolio in a reasonable period of time, given the sort of constraints that are in the market. And I think another dimension is that many investors are looking to evolve their process. So they might start with something over here which is kind of safe and tried and tested, but look as they gain more experience to build and broaden their investment criteria. And that's something that we would fully expect to happen.
One of the issues I often hear with infrastructure debt and similar asset types is sort of the lack of liquidity and the problems that poses for investors. To what extent is that an issue, Mike? Do you think it's sort of the lack of liquidity in some of these investments, and to what extent is that, can that be mitigated by the added return you're getting from them?
I think in general, illiquidity is a bit of a fictitious issue, because if you think our liability stream is 100 years, am I really worried that an investment has liquidity in 10 years or 15 years? It's something that's around in the market as almost a standard feature of investments, but it's not really necessary. Part of my role as a CIO is to look at the liquidity generation of the entire portfolio and to assess whether that's sufficient to pay the pensions that I have to pay every month and every year. And there will be a certain scope in the portfolio to have much longer or much less liquid investments because I don't need the cash flow. I've got enough from somewhere else. So I think the key is to match the liquidity demands of the underlying scheme with the liquidity characteristics of good investments. So I'm quite happy to take long-term illiquid investments as long as they are, I couldn't have an entire portfolio of illiquid investments because I couldn't pay the pensions. And if they all went wrong, I'd be in all sorts of trouble. So it's about balance. And it's about saying I am a long-term investor so that I can take long-term illiquid investments, and there are a lot of investors that can't do those. So just in terms of supply and demand, I should be able to extract a bit of a premium for taking that illiquidity risk. But I certainly doesn't worry me because the philosophy would be to do the due diligence up front, to establish an efficient portfolio, to know what kind of default risk there is in these things and factor that into the valuation. And hopefully, having established the positions in the portfolio, it is one of those long-term things that you just let it run. I would certainly not ever be going into this sort of thing saying, I'm looking to be able to sell these at some point in the future. It's a buy, hold to maturity type investment, and that's the basis on which you go into it.
Mark?
I would just, I would add very much, we're matching long-term liabilities. Our liabilities are non-callable, so we can take illiquidity. That's absolutely right. But we are conscious of the fact that if you have a portfolio with liquid instruments, you have a certain amount of optionality. You have the ability to sell those if a better investment comes along, or if something makes you change your mind on an investment. And these investments can be out there for 20, 30 years. Things can change, your views can change. You could want to sell because you're worried about certain credit things. And I think it's understanding that you are giving up those things rather than the issue that Mike is very right about, that you're matching liabilities. You're very comfortable doing that. You're matching liabilities, but it is going to be much more difficult, should you ever want to, for whatever reason, to trade out of those liabilities, which is why you should get, to my view, you should always get some kind of premium, some kind of extra illiquidity premium over a liquid bond.
The key thing for us to consider in anything like this is if the pension scheme got to a point where we wanted to do a buyout or a buy-in with somebody like Mark, would these be the type of assets that we could transfer? And clearly in this case,
yes,
because
looking at them,
say,
please, we'd love it.
We'd probably argue about the price, given there's an illiquid market and no set price. But fundamentally, that's not a problem because we can.
They're matching the same. We're taking on the same liabilities. They're matching the same liabilities. There's no reason why they shouldn't come straight over to us. Agreed pricing will be a separate topic, but in terms of what they're doing and the cash flows they're providing, they should work to go from a pension fund into a buyout in that situation.
Chris, do you have a view on the liquidity issue?
Yeah, so there has always been a fairly active market within banks buying and selling these type of assets amongst themselves, and as institutions come in, we would expect that to increase and involve institutional investors. And so in normal market conditions, the idea of adjusting a portfolio through selective exchanges or trading, that is a possibility, but clearly it is at the early stage, and there's no pretense here that we have any kind of deep liquid market.
But do you think with more participants getting involved in this market, liquidity is likely to grow?
It should, although the majority are coming in as buy and hold investors. So, but yes, it clearly will develop. And the point you made about people looking to adjust their portfolios over time, that will drive some.
We a couple of issues where we've been the sole provider of debt. We've been bid on those. Yeah. Actually, people saying they'd love to get involved. So we think there is an element of that. You being able to get out if you wanted to at the moment. The world may be very different in 10 years' time, though.
Looking at some of the other risks and challenges for schemes investing in infrastructure debt, a lot of these investments sort of have regulatory challenges, perhaps rely heavily on government regulation. Are there some risks there, sort of changes to legislation, sort of how the government views certain areas? Do you have a...
Yes, I think one has to acknowledge that infrastructure is exposed to both regulatory and political risk because it's dealing with public assets which the public care about and the government of the day care about. So, while it's in a very positive framework, we do see changes in the regulatory approach. And in particular, any government doesn't like to feel that it's overpaid for something. So if they sense that the subsidy regime on some tariffs or payments they're making for a hospital are too high and the private sector are making too much money, there will be sensitivity, and we can see changes. The vast majority of that risk is embedded in the equity which is invested in these businesses, and so we see equity returns suffer due to regulatory change. It's pretty rare that the senior debt is really materially affected by any kind of change in a regulation, but of course it can happen. I would say the other area where there's some exposure is in terms of the pipeline. So of course different types of infrastructure business come in and go out of popularity from a political point of view. We saw the schools programme in the UK sort of being cancelled at short notice, now being restarted, and this makes it a challenge in terms of looking at a future pipeline of new investment projects. And so clearly that is just a feature. These are long term, they take a long time to procure, and they're going to be exposed to that political change.
I think from my perspective, it doesn't cause me too many sleepless nights, because I think we're lucky in the UK to have a pretty established legal regime, and to worry about contractual changes after these are all in place. The government would have to introduce retrospective type legislation, and that hasn't really happened before. So I think once the ink's dry on the agreements, that kind of risk goes away. The pipeline risk clearly is there as an issue.
I mean, I think I wouldn't say it completely goes away. It's still there as a risk, but I would agree that I'm not losing any sleep over these things. There's certain cases that, for instance, on some of the solar deals we invested in, some of the original tariffs were very, very generous. They actually got challenged by the government in court. That challenge was thrown out, and that backs up Mike's point that actually we have a very strong and solid legal framework in the UK that makes you very comfortable that those sorts of contracts are likely to be honoured. Now, if you go invest outside of the UK, and particularly in emerging markets, I think that assessment and that political risk becomes a bigger part of the risk assessment, or a bigger part of the risk in infrastructure deals.
Unquestionably.
Thank you very much. Gentlemen, we're reaching the last part of our debate. I was hoping to ask each of you to sort of sum up sort of your views on infrastructure debt in a few words. Could I start with you, please, Mark?
Yes, but I think for pension funds and insurance companies with long-dated liabilities, infrastructure debt makes an awful lot of sense, because you can provide the investment grade cash flows that you're confident will be around for a long time. If you're going to invest in the smaller project finance deals and do it in-house, you need scale and you need a lot of resources, and it's important not to underestimate that.
Chris?
I think we're at the beginning of a change in the market, which is going to see enormous investment opportunity for institutional investors over the next decade. I think it's an excellent asset class with a great history and future. And so, we really believe that as a credit diversifier, it offers, an excellent opportunity for pension funds and insurers.
Mike?
I would echo both the previous sets of comments. As a match for a long-term liability stream of a pension scheme, infrastructure debt with stable long-term cash flows is a pretty good asset type. So it certainly has a place in a diversified asset portfolio of a pension scheme. As ever, the precise route of implementing that asset allocation is key.
Thank you very much indeed. Thank you, Mark, Chris and Mike. And thank you for viewing. Hope to see you for our next debate soon.